I think we stopped somewhere here last week. We were discussing about the financial institutions, and we completed the discussion on banks. We spend quite a lot of time on banks because banks are the key financial institutions, and we try to understand their business model, how they generate revenue, and what source of revenue they have. All these key things we covered last week. That would be sufficient for this paper. And I'm aware under commercial banking, you will go through the banking concept more deeply. So, even for that matter, this discussion will be helpful as a kind of a support. Now, today we move to uh, the next section, uh, risk. Now, banks face number of risks in conducting their businesses. Now, some of these risks are actually not only related to banks. Some of them are broader risk that you can observe in the broader financial system as well. Those are mostly relevant to banks as well. So that's why we discussed them here. What are the key risks faced by uh, banks in conducting their business? Now we can highlight or list down a couple of risks that the banks are facing. To start with, we can identify credit risk. Some people call it as default risk as well, but the more formal term is credit risk. Credit risk is risk arising due to uh, loss, or in other words, the risk of loss arising due to a borrower defaults his payments uh, in the loan period, or uh, in other words, a person who has borrowed does not honor his contract in terms of paying back the principal or the interest component of a loan. So this is the most important risk faced by a bank, because bank's business model, it's based on borrowing and lending model, which means banks are borrowing from customers in terms of deposits, and those deposits are given out to customers again as loans. So banks make money out of this intermediation. Now, when banks give loans, that is really important for the bank, because it generates revenue to pay back the depositors, as well as for the sustainability of the business. Banks need to generate profit, and that profit is generated out of this lending business. So, if someone is defaulting, that makes banks in a vulnerable position, which means they are losing some revenue. So that is the key risk faced by a bank. Now, if you remember, when we talking about that asymmetry information problem, I was telling you banks are subject to two important concepts: moral suasion and moral hazard and the adverse selection. So adverse selection happens, a bank gives away, before it gives away a loan. Moral hazard happens after bank gives a loan. Both are leading to possibility of default. So that default is resulting a credit risk of loss arising from a borrower who does not make payments as promised. Okay, that's one important risk faced by a bank. Second, liquidity risk. What is the liquidity risk? risk that a given security or asset cannot be traded quickly enough to prevent a loss. The bank should be able to liquidate their assets in order to realize profits. Banks are also making investments. For those investments, they have to have some liquidity, which means without making any loss, they have to be able to sell it back in the secondary market if they want. So that is inability to do so quickly uh, could generate some losses to the bank. Now, this liquidity risk has another meaning also. What is that? Bank should have enough cash to honor their obligations. That is the other definition. Bank should have enough cash to make or to honor their obligations. Now, for example, uh, on a particular day, a bank would have a certain amount of deposits as well as certain amount of withdrawals by customers. It could be directly through the bank or through the ATM. Banks want to customers want to have their money back for various reasons in a particular day. So when customers need money, bank should be able to give that money then and there. So they have to honor the customer request. For that matter, the bank should have enough cash. That is also referred to as liquidity. So both type of liquidity risk is there for a bank. The liquidity risk emerging from their inability to convert assets to cash. The other aspect is the banks are unable to meet customers' needs in providing their liquidity needs. So that is an important risk faced by a bank. Then market risk. So market risk is the risk that the value of the portfolio, that could be their investment portfolio or trading portfolio. Portfolio means their collection of investments. Collection of investments in a balance sheet, there could be two types: for investment purposes or trading purposes. Investment purposes means a bank would buy a certain asset, keep it till the maturity to generate a capital gain. Trading portfolio means a bank would have a day-to-day trading activities, buying and selling securities. For that matter, that is also to make profits. That you call as trading portfolio. Now, if you remember this balance sheet, I think we discussed that day. Here, if you look at the assets, you have this term: financial assets trading, held for trading. Okay? Now, here there's another term: financial investments held for maturity, which means a trading portfolio and investment portfolio. Now, this portfolio value will change time to time due to changes in prices. Prices would change, so as a result, their portfolio value is changing. What are these rises? Interest rate is one of the risks, one of the prices. Now, day to day or time to time, interest rates could go up or go down. When interest rates go up and go down, that has an impact on financial assets. We will discuss that next week in our discussion related to financial markets. There you would see when interest rates are higher, particular assets would generate some high profits. Now, for example, if interest rates are higher, through loans, banks might be able to make profit. But let's say banks are having investments in terms of bills and bonds, government securities. For those securities, high interest rate means the prices come low, prices come down. Okay, so if a bank has purchased a security at low interest, which means price is high, but at a particular point in time, the interest rate has gone down, which means prices have come down. So that generates some capital loss. So you call it interest rate risk. There could be changes in asset prices. Now, for example, bank is having shares. Share prices come down. That is an asset price risk. A bank is having real assets in their balance sheet. So the value of those real assets come down. So that means asset price risk is there. Exchange rate is also matter. They are also impacting their balance sheet. Why? The exchange rate appreciations and depreciations could change the value of the asset. So all these are different aspects of market risk: interest rate risk, asset price risk, exchange rate risk. All these are feeding to change the value of the asset. When you see a change in the value of the asset, that could generate losses, that even generate profits, depending on the movement of the asset, the prices. But if it makes a loss, that is a risk to the bank, market risk. Then I would say these are the key risks faced by a bank: credit risk, liquidity risk, market risk. Sometimes these risks are beyond the bank. Okay, these are coming from factors outside the bank, but the bank is able to minimize these risks. For example, to minimize the credit risk, the bank should select the best customers to lend through their evaluation process, through their credit rating process, through their credit information reports process. Banks can select the best customers to lend. That's how you reduce the credit risk. Now, even if customers defaulted, banks have some cushion for this. Banks are doing some provisioning. Probably you may have heard the term loan loss provisions. Non-performing loan, for non-performing loans, loan loss provisions are allocated. For liquidity risk, banks are having some buffers. For example, bank is having a buffer at the central bank. We know that is statutory reserve ratio. If there is an urgent need, banks can use funds from that statutory reserve. Banks having a liquid asset ratio maintained, right? They are required to keep some amount of cash assets, either cash or either securities, any form. They have to have some cash immediate need for immediate needs. To reduce market risk, banks can diverse their assets, right? Not only invest in one asset, they can invest in various assets, diversification. By that way, they can reduce market risk. So there are some risk mitigation measures adopted by a bank to face these risks. Other than that, banks are facing some other risks. We can identify few other risks. The operational risk arising due to execution of company's business functions. On a day-to-day basis, due to the failures of functions, there could be some operational issues. For example, banks can have some system failures, right, on a particular day. Uh, let's say some electricity, some failure or some major failure of electricity or whatever. Some issue due to inability to access the premises, right? Let's say a kind of a bomb blast or something has happened, some fire has erupted, so the operations cannot be carried out. Even people could bring some operational risk. For example, a strike goes on. Those are disruptions to normal execution of companies or banks' functions. Reputational risk is there. Reputational risk means the risk related to the trustworthiness of business. Now, this reputational risk is very important for a bank because one single incident could lead to a collapse of a bank. Bank business is based on trust, as we know. If trustworthiness is breached or damaged, that could lead to some reputational damages and risk. Okay. Macroeconomic risk is there, risk related to aggregate economy. Now, some of the risks are arising in the broader economy. For example, high inflation rates, external sector pressures, low economic growth. Those are risks arising in the broader macroeconomy. Banks are unable to correct these things because that is beyond their risk. Now, for example, these now last year actually there was a significant macroeconomic risk for banks because last year was a year largely impacted due to COVID pandemic. We have seen economic growth was negative, so that creates a situation people are not borrowing from banks as well as people are defaulting because negative economic growth means people don't have money to pay, no income. Those are some macroeconomic risks. Nowadays, we talk about cyber risk associated with financial losses, disruptions to operations, or damages to organizational reputation from negative impact a negative event that impacts the information and information systems of banks. Now, today's world, banks are heavily dependent on technology, especially internet-based activities, cyberspace-based activities, fund transferring, transactions, information sharing. All these are coming from the cyber space, or it is used to support the activities. Now, if something happens in the cyber space and information technology related aspects, that is a huge risk for a bank. Especially that risk is manifold. Sometimes you may lose money. I hope you remember last year, or I think 2 years back, there was an incident. Hackers have attacked uh, Bangladesh banks, Central Bank of Bangladesh information system, and they have been able to transfer money out of the accounts. I think we have heard one Sri Lankan account has received that money. Right? The hacker was able to divert money to somewhere else. It's a huge risk. Sometimes they might be able to access information, right? And that can be used for other purposes. So those are some of the key cyber risks that the banks are facing nowadays. This was not discussed sometimes back because cyber risk is a kind of a new risk that we have identified. Okay. Now I'm looking for some past paper questions. There were some related questions. Just trying to trace couple of questions that we can. Okay, now there's one question in 2019 March paper. If you have the paper, you can take it out, or you can open it if you have the soft version. March 2019, question number 5. Question number 5, number 5.3. This is the question. List and briefly explain the risk threats that gained significance with the emergence of new technologies in the financial intermediation process. Right? Now, the marking scheme has given a couple of answers which are very relevant to what we discussed right now. So, one risk that they have identified as the operational risk due to the emergence of new technologies and financial intermediation. The key risk that they have identified, operational risk. With the emergence of new technology, financial intermediation is heavily dependent on technology. So any breakdown in technology lead to operational risk of a bank. Okay, that's one aspect. Second answer is threat of increasing money laundering activities. Now, heavy reliance on technology and related aspects, we have observed uh, people who are attempting to money laundering, they try to use these digital form of currencies, digital money and channels to launder their money. Okay, which means they try to adapt illegal money into the formal system by using technology, mainly by purchasing of financial assets in electronic form, which means cryptocurrencies and digital currencies. That is one thing. Through money laundering, there is a risk on the financial sector. Third one, as we just discussed, increase in cyber security threat. Right? So as financial institutions are more reliant on technology, they are very exposed to cyber attacks. Cyber attacks, cyber theft, cyber frauds, all these cyber related threats are there as the banks are heavily reliant on technology. Okay, so these are the key risk threats faced by a financial intermediary or a bank today because of emergence of new technology. Then the next question, question number 5.4, again related to what we discussed right now. Explain why cyber security is important to today's banking institutions. Briefly explain 3 types of cyber attacks. Now, this fourth question is entirely on the cyber risk we just discussed. It asks why it is important. Now, we have discussed present day banks are operating in a cyber world, mainly using the internet. So, most of the transactions processing uh, done through systems and delivery channels of the banks are based on internet. So therefore the banks operations are prone to various cyber attacks, right, because of the heavy reliance on the cyberspace. So what are these cyber attacks targeting the banks? There are various aspects of cyber attacks. When we say cyber risk or cyber attack, there are various aspects. What are these aspects or types of risk? One is hacking. Right? I think you are very familiar with the hacking, or sometimes you call it intrusion attacks, which means uh, a person or a group of persons through the computer, they break into your security network and enter into your information, and they are able to destroy, modify, or steal your information or data through hacking. Not only that, not only they steal your information or modify or destroy, they can use such information and such ability to do unauthorized transactions. As I said, the Bangladesh case, bank case, it's a cyber attack, it's a hacking incident. They were able to carry out some unauthorized transaction. Now, another type of attack is malware. Right? The term malware indicates the who attacker use some malicious software to control or disrupt the operations of the system or a device. I think in simple terms, malware is a kind of a releasing or sending a virus that could affect the system in different ways. When a virus is a virus attack is there in a computer, that could destabilize the system, that could lead to loss of information, that could lead to corrupt your system operations. Many things can happen. Malware attacks. Okay. And there's another form of cyber attack. I think this term is not that familiar, but that is also one form. Uh, Distributed denial of service. Some people call it DDoS. Distributed denial of service. This is also a form of attack. In this case, the system is disrupted by directing unnecessarily large flow of traffic to the system. Now, sometimes we know when there is a large traffic, you cannot access the system, or you cannot, your system becomes slow. When a large number of people is accessing a particular system, let's say banks, uh, uh, the personal banking platform, large number of people access means your system gets slowed down. Now, sometimes these cyber attackers, they do it deliberately. They direct large number of artificial transactions or attempts to transact, which makes the system slow, and legitimate users will not be able to access this system. That is also one form of uh, cyber attacks. And also nowadays we know there is a very famous type of cyber attack, phishing email. Phishing, you write phishing as PHISHING, not phishing, right? Malubanonave. Phishing emails. That is one of the most common forms where you get some fake websites, email addresses, uh, requesting you to divulge your sensitive information or to do transactions with them. I think if you open your spam folder in your email, you will see these phishing emails, hundreds of emails. People are sending emails, let's say I'm so and so from African region, from this region, Russian region. Likewise, you get some information. Some people actually get caught to this. They click those emails and open their links, and sometimes they have lost their data. Sometimes people actually done some transactions with them by way of transferring money. So people easily, some people without any knowledge, they could be get into these troubles for phishing emails. So these are some of the risks faced by banks in relation to cyber threats. Okay, I'm trying to get another question. I remember there was another one. Okay, found it. Now this question is in 2018 September paper. Question number 444, last part of the question. So what is the question? List and briefly explain four major risks faced by deposit mobilizing financial institutions. There you have to discuss four types of risks faced by a bank. Now we have discussed here roughly uh, three important risks here, and here also we discuss another four types. So if you write down four out of these would be sufficient. So we already know credit risk is most important risk, liquidity risk is there, market risk is there, and you may write one of these: operational, reputational, whatever. Make sure you have to give some explanation for each and every risk. List and briefly explain means you should not only give the list of risks, you have to explain briefly why it is important, how banks are facing, and possibly the repercussions of this risk. Okay. Now this part is very important because, as you have seen, there are questions in your paper time to time related to this risk. Any question? You are there, no? You following me, students?
Yes, sir. We
Yeah.
can hear you.
Right.
And there's one more question, sir. In 2019,
Hmm.
I did 2019.
March paper or
No,
September?
no, no. 2009 September paper, sir.
Okay.
2019 September paper. There's a question number. Financial marketplace important. Yeah, that's the question number 3.
Yeah. 3 3, right?
No, question number 2.
Ah, yeah.
3.
2 3. You are correct. Question number 2 3. Explain credit risk and liquidity risk. Discuss how credit risk arising from lending activities would lead to liquid risk in a bank. I think we discussed credit risk, isn't it? We discussed liquidity risk as well. Now the question asks why liquidity risk could arise due to credit risk. How it could happen? What do you think? These two risks are related in that sense. Why it is risk? it's a combined risk.
Because it leads with the customer's money when defaulter not pay the installment, bank has to go for the liquidity risk.
Bank will have a cash flow issue, isn't it?
Yes.
Now banks are running day to day on based on customer deposits and customer loan activity. Now when people are not paying on time, because banks are doing a cash flow projection for their operations, so if the banks are not getting enough money as per their plan, they will have some liquidity issue. So there is a clear link. When borrowers have defaulted loan payments in terms of principal or the interest, banks will not have adequate money to honor other transactions. For example, depositor money. If investors have to be paid, you have to have money. So that is kind of a risk to the bank. And in the same paper, question number 3.3 is also related to risk. Specify 5 emerging increasing risk in the financial sector due to high reliance on technology. Right? What are these risks? These are not actually broader risks in terms of the banks, but these are some aspects of broader risk. Now, for example, due to cyber risk, due to heavy reliance on technology, you might be facing money laundering risk, technology risk, terrorist financing, right? All these different types of risk could arise when the banks are increasingly using high technology, high reliance on technology will lead to such risk. So all in all, you can see in papers, at least uh, one part of the question is related to risk. So you have to have some understanding on this. Now, as I said, banks are trying to manage this risk. They have certain risk management practices to control the risk or to minimize it. So as a result, banks are trying to maintain their resources at least uh, at a minimum level to manage this risk. Now, for example, the banks are maintaining capital. Banks should have enough capital. So banks are having some capital ratios for that matter, right? Net, core capital ratio. Uh, Likewise, tier 1, tier 2, there are various definitions. I'll be discussing those in the regulation section. So these different levels of capital are used as a buffer by bank when there is a kind of a loss to the bank emanating from defaults due to credit risk. So losses are absorbed mainly through capital. So as a result, as I said, banks are having enough capital. That is one way of mitigating the risk. Banks should generate adequate profitability. Now, when banks have some profitability, they can allocate some profits to capital and they can have some strong position. So that is also one way of minimizing losses arising due to various incidents. Liquidity is management is one of the key aspects of the bank. Banks are trying to manage assets and liabilities in a prudent manner. That's why I said banks do a cash flow projection and see what are the cash outs, what are the cash in, uh, what liabilities should be paid, what are the assets that the bank would be having. Likewise, they try to do some management of assets and liability without having a greater mismatch. In a bank, you might have heard this committee called ALCO, right? ALCO means Asset Liability Committee. On a day-to-day basis, they are looking at this prudent asset management, asset liability management without generating mismatches. Okay. And banks are adopting good management and corporate governance practices. Corporate governance means basically good ethics, good practices, internal control systems, and all that. These are also used to minimize the risk of a bank. And also, compliance with prudential requirements means requirements are issued by authorities. For example, the central bank. So, time to time, central bank is issuing certain regulations, requirements for banks to comply in order to ensure that the banks are in correct behavior and uh, they are conducting their operations in a prudent manner. So for that matter, compliance is really important. And as you are aware, every bank has a key compliance officer. His role is to look at whether the bank is complying to all these requirements and guidelines. Okay? So by adopting this, bank is trying to minimize the risk emanating in the system that could lead to some losses of the losses to the bank. So these are some of the aspects of risk management. Now let's move to other type of financial institutions. I told you we have to have some idea about all other financial institutions, at least in a brief manner. Now we spend some reasonable time on banks, discussing the banks, but here we are just trying to understand the nature of these institutions. So we are not going into too much details. We just try to understand what are these institutions and their business type. So to start with, we have non-bank financial institutions, NBFIs. Non-bank financial institutions provide banking services to customers without meeting the legal definition of a bank. So in other words, non-bank institutions do not have a banking license. They are not having any banking license, but their operations are very similar to banks. If you look at their products and services, non-bank institutions are accepting deposits, making loans and credit facilities, savings products, investment services, money transfer services, all these are provided by a non-bank financial institution. And also they support investments in property, preparing feasibility or market studies reports for companies. So some advisory services are also provided. So when you look at these functions, they are very broadly similar to a bank. Only difference, they don't have a banking license. When they don't have a banking license, that indicate they are not engaged in current account transactions. That's the only difference. Other than that, every transaction is carried by a non-bank also. For example, even credit card facilities are having these non-bank financial institutions. In some countries, these NBFI, they are able to do foreign exchange transactions as well. Now in Sri Lanka, non-bank institutions, they are not dealers in foreign currency. But in some countries, they even do that. So I hope you can understand they are very much similar to a bank, but no license of a bank. One important thing of this non-bank category is they are providing catering to a segment which might not be considered as most creditworthy or some categories served by banks. Now in Sri Lanka, now we know people would access bank or finance companies for their operations without any major distinction. But in the past, we have seen people who were not being able to access banks uh, effectively due to collateral issues, due to documentation issues, we have seen they are facilitated by non-banks. So in that sense, for many years, these non-bank category, non-bank financial institutions have been serving to segments which do not have access to the banking sector due to various reasons. Now actually it's changing. Both are providing services competitively. Then we see merchant banks and investment banks are there in the financial system as intermediary. Now, in operation, both merchant banks and investment banks are similar in operation. By looking at their activity, you would see broadly they provide similar services. Similar services for they help management of security issuances, which means documentation, designing, marketing, allocating for securities. This part is done by these institutions. And most of these merchant banks and investment banks, they are basically helping to uh, uh, helping as security underwriters. Underwriter means they are basically uh, committing to purchase the unsubscribed portion of securities. Now, when the securities are sold, let's say investors have bought everything, then there's no issue. But there could be instances investors have not fully subscribed the security issuance. So in that case, sometimes these institutions purchase the balance part. You call it underwriting. Likewise, even advisory services. All these are very similar for merchant banks and investment banks in operation. The difference we can identify of these institutions, merchant banks with companies that may not be large enough to raise funds from the public. In other words, merchant banks are helping companies who have not been listed in the stock market. If it is listed in the stock market, they can issue stocks to the public, shares to the public. That's feasible. Now, sometimes there could be some small entities who are not in a position to raise funds through the stock market, but still they have a good business potential. So for them, merchant banks can help with raising money and also in terms of helping for their investment processes. These small companies sometimes are not having adequate information, very comprehensive set of disclosure mechanisms are not there. So in that sense, big investors would not like to invest in these companies because there's no adequate information, company is small. So in that case, there could be some small scale investors, people who would like to give loans. There could be some certain investors like that. Those are facilitated by the merchant banks. Investment banks are a bit different. They provide services for companies which have some large potential and also who have access to the stock market and the formal financial market. For example, if a large company wants to raise money and they are already listed in the stock market, investment bank can help with them, right? So the security issuances, trading, investment management, all these can be supported by a investment bank. So they can also help companies to go for IPOs. IPOs means issuing shares for the first time, initial public offerings. So if a particular company wants to go for an IPO, investment banks can help for them. And also in modern world, uh, investment banks are helping for mergers and acquisitions of companies. Mergers and acquisitions means if you take two companies, those two companies can get together and become a new company, merger. Sometimes some company acquires other companies. A large company may acquire a small company. You call it an acquiring. So these mergers and acquisitions are supported by investment banks because they are having expert knowledge, they can advise, they can arrange, they can do research on behalf of the company and the client. So they are in a kind of a strong position to do it. So all in all, these two types of bank, merchant banks and investment banks, you can broadly say they are supporting the clients in terms of investments, raising money, advisory services, portfolio management, uh, and also uh, releasing information. All these are done by these two entities. Only difference is, as I said, merchant banks are catering to a kind of a small scale in companies or investors. Investment banks are helping more formalized investors or large companies who have access to the broader capital markets. Okay. Then we have leasing companies operating in the financial system. Leasing companies are basically providing leasing services. Leasing services, this product I'm discussing in the financial products section as well. As you are aware, leasing is a lease is a contractual agreement between two parties. Who are these two parties? A lessee and a lessor for the use of an asset. So lessee is the user of this asset, lessor is the owner of the asset. Now most of the time, the leasing company is the owner of this asset, which means the lessor. So it is the legal owner of this asset. So during the lifetime, during the contract time, actually not the lifetime, during the contract time, the ownership is with the leasing company. So person who has taken the lease or the user or lessee, he would be basically paying these lease rentals according to the contract for the utilization of this asset. End of the period of the contract, the leasing company can convey the ownership to the lessee, which means for the user, they can hand over the ownership at the end of the contract period. So the lessee incurs all benefits, costs, and risks associated with the asset. But at the end of the period, he would be having the ownership. So the importance of these companies, leasing companies, they are helping to the clients who do not have money pay upfront to purchase assets, especially real assets and movable assets like vehicles, people who do not have money to pay upfront and get the ownership, this mechanism, the leasing companies are helping them by way of allowing them to own an asset or utilize an asset for their activities. I think we have good examples in Sri Lanka leasing industry. Buses, people buy buses, even cars and all these, through these leasing contracts. They are not in a position to pay money upfront, the entire money. So what they will do, they will go to a leasing contract and monthly you pay a certain amount of money as a land rental and you enjoy the asset. Enjoy in the sense you use it, but you have to incur all the cost risks associated with the asset. It's a good model to own an asset through a financial facility provided by the leasing company. And there are building societies and credit unions. Now, these terms we are not that familiar in our case, but in most Western countries, you have these set up as financial intermediaries, building societies and credit unions. A building society is a kind of a financial institution owned by members as a mutual organization. So it's a member-owned institution. These are very common and popular in UK sometimes back. So in small towns in UK, they have these building societies. So these are financial entities created by owners, right? So they basically provided some banking facilities, especially for mortgage lending. I think for purchase of buildings in the sense the real assets, they help. That may be the reason they are called as building societies, but they mainly provided funding for lending, building societies. A similar institution can be identified in those countries, credit unions. Again, it's a member-owned cooperative controlled by the members. Their role, again, it's very similar to a building society. They also provided lending and financial services to banks. They also promoted thrift in the sense savings. Building society is also same thing done. The credit union also done the same thing, but it's a different model. Now, one important difference between the building society and credit union, their financial services had different terminology, different terms. Now, for example, their savings account were called as share accounts. Their check-in accounts, they provided some current account facilities also. They call it share draft accounts. Credit cards, share term certificates, they call it certificate of deposit, they call as share term deposit. So likewise, same products like a bank, but under a different heading. So all in all, these building societies and credit unions, that's why I have put them together. They are basically member-owned institutions promoting savings and lending. And especially in the case of building societies, their main business activity was targeting the mortgage lending and very similar to, they operated very similar to a bank. Okay. Then we have microfinance institutions. Now the term microfinance indicates a source of financial services for entrepreneurs and small businesses who have limited access to banks and related services. Now, in many countries, microfinance has become a very important model to empower poor people and also less privileged people. We normally know poor people and less privileged people, they do not have proper access to banking system or formal financial services due to unavailability of collaterals, due to lack of good credit record. They don't have pay slips. Likewise, they are having some difficulties in accessing banking sector. So that gap is basically fulfilled by microfinance institutions. They provide financial services for these SMEs or small and medium size entrepreneurs to fulfill their financial needs. Now, microfinance institutions apply two types of models for their financial services delivery. One is relationship based banking, which means they have individual entrepreneurs or small businesses where they finance, providing financial services. Another important one, very popular model under microfinance is group-based models, which means these institutions lend for a group of people, group of entrepreneurs or small businesses, and all the banking or the financial activity happens as a group. Loan is given to the group, repayment is done as a group. So I think even in Sri Lanka, this model is very popular in certain part of the countries. Group-based delivery channel. Now, not only the financial services in terms of loans and deposit taking through this microfinance activity, sometimes we see they are providing insurance services, advisory services to medium or small scale entrepreneurs. So I think
Excuse
in that sense,
sir,
similar to my, yes.
sir, the Gramia loans is kind of the group
Sorry.
financing. Gramia Bank, that Samurti loans kind of coming under this.
This rural bank,
Yes.
it's a different setup that we have in Sri Lanka, right? It's not actually a kind of a bank under a formal financial sector that is created by a particular ministry or department, the rural bank, right, in Sri Lanka. But that is also, we are not discussing it here specifically. The reason is it's not a very common model in many countries, right? For those type of models, what we have discussed, these credit union building societies, they are like, these cooperatives in other countries. In our case, we have these rural bank. I think we have an exam question into these Samurdhi banks and Divinaguma banks. Let's come to that point when we discuss questions, right? They are also not coming under a formal financial sector, and it's not under regulation. Okay. What we discuss all this here broadly like coming under regulators' perspective, maybe a central bank or some other. But those Divinaguma rural banks, those are not under regulation of a particular financial authority, but they are under different ministries. Right? Clear? We'll come back to those when we talk about exam questions. This rural bank is not a microfinance institution. Clear? But many banks have these microfinance arms. In Sri Lanka, we have very number of microfinance institutions. We call them as PFIs, Participatory Financial Institutions.
Can I have some examples, sir?
Sorry?
Example?
I can't hear you properly.
Example, sir?
Example for what?
For the microfinance institutions?
There are a number of companies. I can't remember names of these companies. There are a lot of companies operating in Sri Lanka under various names. these are actually established by private people, entities, and also the banks have some arms, microfinance arms. Now, for example, if I remember, a particular bank is having a Grameen Bank, right? Grameen Bank means that is their microfinance arm. A particular, I don't want to quote name of the bank, but a particular bank has that name, Grameen Bank. So likewise, under banks also, they have set up this microfinance institutions to cater these poor people. This model is very common and popular in countries like Bangladesh, Africa, even in Latin American countries. Of course, in Sri Lanka, we have these microfinance companies, and we did not have a proper mechanism to monitor these microfinance companies. But I think in 2016, the government enacted an act, Microfinance Act for Sri Lanka. So under that only, now these microfinance companies have been formalized. But still, most of these companies are not under the direct supervision of the central bank. There are a lot of private microfinance entities operating in Sri Lanka. Let's move on. Now, we have insurance companies as financial intermediaries. Now, insurance product, I think you have some idea. That's an arrangement to protect or to give some compensation for clients in the case of a future loss due to unforeseen event. Now, insurance is based on probability, right? Now, it's not a kind of a you take an insurance product, you get the benefit definitely. It's not like that. The product is designed when you face some unforeseen event and loss, unanticipated loss, then the insurance company basically compensates you. That is the original insurance model that we have seen in many countries. So the policy, the insurer, we call them as insurance carrier, sells the insurance facility. The policy holder, which means the person who got the insurance, having a policy, every month or in a particular time period, he pays a kind of a premium, a deposit to the insurance company to enjoy this facility. Nowadays, I think this insurance product has also modified in terms of an investment. Right? Now, people take an insurance as an investment because at the end of the insurance period, money is paid back with an interest. So they have become a kind of an investment method as well, insurance. But the original idea of insurance is give some protection and provide some compensation in the case of a unanticipated loss. So these insurance companies, what they do, they provide the insurance facility, collect the premiums, invest that premium in various investment avenues and generate returns to pay out for losses. Now, in the economy, these insurance companies are considered as long-term financial institutions. So they are investing mostly on bills and bonds, especially bonds. If you take in Sri Lanka also, the insurance companies have mostly invested in long-term bonds because that is kind of a generating return on a long-term basis. And we know there are various type of categories of insurance. Long-term insurance is there. Long-term means you call them as life insurance. General insurance facilities are there. General insurance means in terms of these insuring assets, vehicles, buildings, machinery. You call them as general insurance. Reinsurance products are also there, which means an insurer can get another insurance. I think it's very special in this common in this shipping industry. The shipping industry, the freight forwarders, they get reinsurance from somewhere. In the case of a catastrophe, if they have to pay a large amount of money to a policy holder for their client, they also have a backup insurance from another insurance company. You call it as a reinsurance facility. Okay, I think that gives some idea about the role of insurance companies. And in some countries, even in Sri Lanka, I remember there was one company sometimes back. I don't know now whether they are operating. A service called factoring companies are there. So factoring companies are actually third-party financing companies that provide some capital, actually working capital, in exchange for collection of their unpaid invoices. Now, let's say a particular company is having unpaid invoices. Unpaid invoices means they are cash receivables. Right? They have provided services to other parties or clients, and some bills are there with them. These have to be collected. Now, there are some companies who purchase these bills from them and providing short-term capital for their liquidity purposes. As we know, when money is not paid by the customers, you have some liquidity issues. You don't have immediate cash. Now, when you don't have that, you can get the service of a factoring company, which means you can sell your bills, receivable invoices to a factor. Factor means to the company for a discount and get some cash for to do your business. So the factoring company will receive the money of that invoice. They will collect on behalf of you, but they have already provided services to you. Okay? This is done for the purpose of giving some immediate cash for companies who need cash. But it has to be actually a certain model that you should have some bills to be received. Okay? I don't think a bank can have a factoring facility because bank's business is it's like having then and there you have customer transactions. But let's say a company who's providing goods and services to another person of some goods, then he might have some bills receivables. So those receivables or invoices can be discounted with the factoring company for cash needs. Cooperative banks, someone asked this question, whether the cooperative banks are banks can be included here. Of course, banks, cooperative banks are also financial intermediaries. They are helping to mobilize savings from public, especially from rural areas and from agricultural societies. They can mobilize these funds and provide money back for their activities. I think in Sri Lanka also we have this model, very popular, cooperative banks. They are like member-owned institutions. I think it's very similar to those credit societies and credit unions and building societies. Even in our case, we have these institutions providing services for their members. But as I said, these are not regulated under, in Sri Lanka, not regulated under banking regulations. Right? In Sri Lanka, these are regulated under cooperative legislation. There is a special law for cooperative purposes, and they are under cooperative department. not under any central bank or any other regulator in the case of Sri Lanka. But in some banks, in some countries, these cooperative banks, they are coming under both banking regulation and cooperative legislation. Pension funds, they are also financial intermediaries. Pension fund, we call them as a superannuation fund. It's a kind of a plan or a fund, a scheme that provides retirement income for the members. Now in Sri Lanka, we don't have, now in some countries you have these private pension funds, which means a private entity is collecting your member money, and at the retirement, they are basically providing a retirement benefit. In some countries, you have these private pension funds. In Sri Lanka, we don't have a private pension fund. Funds other than these companies are maintaining their own pension funds for their uh, employees, but other than that in Sri Lanka we don't have companies who are having this private pension fund facility. So these are actually owing or holding large amounts of money to invest, because being a fund you get money from various members. So in that sense, these are also considered as large investors in financial markets. Especially, they are also investing in long-term financial products. In Sri Lanka, I told you, uh, insurance companies are mainly investing in long-term assets. Similarly, EPF. In Sri Lanka, we have Employees Provident Fund. That is a pension fund, government-owned pension fund for private sector employees. These their investments are basically long-term for many years. Sometimes more than 10, 15, 20-year investments are there. They are also investing in stock markets. If you look at advanced countries, mainly the stock market is mainly financed by these pension funds. These people who are willing to generate high returns, people have invested in these pension funds, and they encourage those funds to be invested in the stock markets, because the return in the stock market is high. But at the same time, as we know, the risk is also high. Sometimes we have seen the money get eroded in the through the investments in the stock market of these pension funds. During the global financial crisis, we have seen a lot of people have lost their money who have money in the pension funds due to stock market investments. But that's done because of high return. So in these pension funds, sometimes contributions you contribute to the fund, and at the end of the period you get money back as a retirement benefits. So defined contributions and defined benefits are there, which means at the time of the joining, it's very clearly stated what sort of contributions that you have to make, some statutory contributions, and also at the end of the period, how do you get this money back is basically defined in terms of the regulations of the fund. Some funds are fully funded. Fully funded means you have enough money to pay back, right? Which means you have large money compared to your liabilities to pay back to your members. Some funds are underfunded. Underfunded means you don't have enough money to pay back your benefits. Now, in most of the countries, government pension schemes are considered as underfunded, which means the government does not have enough money to pay for their pensioners. The amount of their liability is higher, than the fund size. In some countries, you observe. But in the case of EPF in Sri Lanka, it's a large fund. It's a fully funded fund because there's enough and large amount of money to pay back. Unit trusts. This is a model to set up to collect savings and investment to do investments in financial markets. Why these are considered as intermediaries? They collect funds from the public by issuing units. Units means it's like shares. They issue units to investors. Investors means to the public. And these money collected by issuing units are invested in other investment avenues. That's why they become an intermediary. For example, a unit trust company would raise money from public, and that money they go and invest in the stock market. They go and invest in the bond market. They go and invest in the real estate market. By investing, they generate a return. It's the profit, right? And that profit is distributed among the members of the unit, which means it's a kind of a dividend to the members. So it's like a small stock market, right? People who do not directly participate or who do not have a wish to directly participate in the stock market, they can go to a unit trust company and invest. In Sri Lanka, this is a very famous model. We have, I think, number of unit trust companies operating in Sri Lanka, 10, 15 companies as I remember. So these companies are offering units to small investors and collecting money, and that money is invested in the stock market, in bond markets, as I said, to generate returns. Based on the structure of the unit trust company, there are some specialized companies for specialized activities. For example, some unit trusts are specialized in investing in the stock market. Some are mainly in the bond market. Some have both mixture of investments. So likewise, depending on their model, their specialty is defined. Then we have escrow companies. This is a little bit new idea. This is an intermediary because it holds money and documents between parties, between the two parties. So it's a neutral party, and that facilitates buying and selling assets. Now, to understand the escrow company, the best example is the real estate company, real estate transactions. For example, in India, we have this setup. In Sri Lanka, I'm not so sure whether we have escrow companies. I haven't heard. But the model is this escrow company is maintaining an account for the customer. So customer deposits money in the escrow company, and the escrow company is transferring the money or paying installments for the seller of the asset. If it is an apartment, for example, now usual practice is what? If you buy an apartment or a building, you go to the seller and you pay and you buy. If it is a developer of an apartment, you directly go to the developer and you pay monthly or whatever the amounts until the completion of the apartment. But there is a risk sometimes that developer might not complete the building. So by that time, you might have lost your money. Escrow company in between, they will coordinate this. They will transfer money partly by keeping the money on behalf of the two entities. Two entities means the buyer and the seller. Right? So it's a legal concept or a kind of entity facilitating a transaction between two parties by way of maintaining the documents and money. For that matter, the escrow company will charge a fee. So this is very popular in most of the countries who have an active real estate market. I think in countries like India, Malaysia, this concept is very popular because in those two countries we see a large apartment boom, and there was a situation, these developers, they have collected money and they have not fulfilled their requirement in terms of completing the apartment. Then this escrow setup uh, came in the middle as a financial intermediary. Now let's look at different types of financial services providers quickly. We have financial advisors. Now remember, we have from this point onwards, we are not discussing an intermediary. Intermediation part now we have covered, right? Various types of institutions we have discussed. This point onwards, we are looking at the other aspects of financial institutions, that is service providers. So we have type of service providers like financial advisors. Financial advisor is a kind of a company or a professional providing information and advice on financial products and services to their clients. So he would create a financial plan for their clients. Now in most countries, there is a profession called financial planners. There are companies doing financial planning. Probably you may have heard. So planning means they do not collect any money in between to facilitate your investment. Instead, what they will do, they will give advice on your investment plans, insurance, mortgages, where to save, real estate issues, retirement plans. All these advisory part is handled by these financial advisors. In Sri Lanka, I think this is done to some extent by banks. We don't have this profession developed in Sri Lanka, financial advisors. The reason is most people, they do not go for financial advisors for advice. Instead, they rely on their own financial institution or their bank or non-bank institution or whatever. But this is a profession practiced by many advanced countries, financial advisory services. And there are fund management or asset management companies. They are helping to manage the funds of the clients. They do not take money into their hands. So no intermediation. But what they do, they help in the pooling funds of their customers and investing those funds in various investment avenues and giving advice how to invest and generate returns for them. Do diversification. Diversification means investing in various investment opportunities. Those are supported by these asset management companies. Now in Sri Lanka, we have a couple of asset management companies. I think related to banks also, there are asset management companies established. What they do is they help in investing clients' money in various securities. Brokers are there. I think this term broker is very familiar to us. What they do is they arrange a transaction between a buyer and a seller. And by arranging the transaction, they charge a commission. And when the transaction is done, they get this commission. So what is the primary responsibility of the broker? He brings seller and buyer together. So it's like acting as a third party to facilitate a transaction. So they furnish information regarding prices, products, and all this, and facilitate the transaction. I think this brokerage industry in Sri Lanka, we can see under many areas. For example, in real estate industry, we see this brokerage. People are helping to, or companies are helping to execute a transaction between two parties. In the stock market, we have this brokering company. Probably you may have heard the term stock brokers. There are a number of stock brokers. I think more than 10-15 stock brokers operating in Sri Lanka. They facilitate stock trading activity. There are brokers in the money market. Money brokers are there. So they are facilitating money market transactions, repo market transactions. So which means arranging a transaction between two parties. Venture capital companies are there. Now these venture capital companies, it's again a concept to facilitate small and new business entities. Now there are some companies who are like startups. Startups means they are at very early stages, but they have a very good potential. Now, since they are a startup, they cannot go for large bank loans. They cannot go for stock market to raise money. So as a result, they are in a position, not in a position to have enough capital for their expansion. For those matters, there are companies to help. Those companies are called venture capital companies. So they are financing companies to provide startup capital for these small firms. Sometimes you call it as seed capital, seed capital. And in Western countries, we have this concept as angel investors, which means some high net worth individuals. They are funding this type of small or some early stage companies. They know these companies have some good potential. Now, for example, let's say a young guy invent something. Let's say during this time, some person invents some vaccine or a medicine for COVID. So it's a new venture, business venture. He might have a good potential. But since he is new, banks are not giving loans, no way to raise capital from the stock market. But high net worth individual can help him as an angel investor. So that is providing venture capital. Venture capital means you provide some seed capital to carry out business. Payment service providers are there in the economy. For example, offering online services for accepting electronic payments by way of various payment methods. We know there are various payment types like credit cards, bank payments, direct debits, bank transfers, real-time transfers. All these are payment methods facilitated electronically. To facilitate this, there should be some providers. with the softwares and the payment gateways. So those companies, you call them as payment service providers. Now we know banks are providing various card facilities. To provide those card facilities, the bank should have some payment service obtained somewhere else. If you take your credit card or debit card, you would see on the credit card, there are some companies mentioned, Visa, Maestro, Xerox. Likewise, those are companies. Who are these companies? They are payment service providers who are providing the software and the payment gateway to facilitate these electronic transfers. I think we have an example here, credit card companies. These credit card companies are actually payment card companies. They provide some electronic facility in terms of the software and the payment gateway to have these credit cards in operation. Now there are money changers and dealers in the system. They are also not intermediaries. Money changer basically exchange currency with you. For example, in PETA area in Sri Lanka, we have these money changers, authorized money changers. They have given the license by the central bank to exchange money. They can buy foreign exchange from you and give away rupees. Okay. And also there are money dealers. Money dealers means they are like entity who are like to buy certain assets into their accounts. Now, best example is in Sri Lanka, we have these primary dealers. Primary dealers, they are buying securities for their accounts and selling back those securities from their accounts. So you call them as dealers. So what I want to highlight here, a broker and a dealer is different. Broker does not have an account. Broker does not buy shares for his account. Broker does not buy money or borrow money for his account. He only facilitates the transaction. But the dealer, he is having an account. He purchases securities to his account. You call it own account at the bid price. Bid price means buying price. And selling those securities to another person from his own account at the ask price, which means selling price. So he makes a profit due to the difference between bid price and ask price. Broker does not do that. Broker only gets a commission. Dealer gets a profit by dealing in money or securities for his own account. I think it's clear. There are exchanges in the economy. Again, they are not intermediaries, but they are marketplaces to facilitate transactions in securities, commodities, derivatives, etc. The best example for an exchange is the stock exchange. In the stock market is not intermediate in transactions, which means the stock market does not take money into their account and give it to someone else. Instead, they facilitate the transaction by providing a marketplace. Now, one important aspect of exchange is it's a very organized, formal, regulated place. That's the key feature of an exchange. So if you look at the stock exchange, it's a very formalized, organized place. Two more things to cover. The securities depositions, depositories, sometimes you call it depositories, where the securities are stored until they are transferred to someone else. Now, for example, let's say you buy a government security, a treasury bond. So those treasury bonds are stored in this depository where you can keep it as a safe place. And it helps smooth clearing. Clearing means to transfer to someone, you can do it through the depository. Now in Sri Lanka, we have two main depositories, one at the stock market, you call it CDS, Central Depository System in the stock market. And there's another depository at the bond market, which is operated by the central bank. You call it CDS for government securities, Central Depository System for government securities. But it's a central location to keep securities. Last one, crowdfunding. Crowdfunding, it's again new concept. Now this has become very popular through this internet-based money collection. Under crowdfunding, you can collect money for someone else by raising small amounts from a large amount of people through internet. Now, for example, let's say for a healthcare project, for medical expenses, or let's say for art project to do a film or whatever, you can have this crowdfunding mechanism, which means you hire a entity to raise money on behalf of you. If you are a known figure, let's say you are an artist, known artist, you want to raise money to do a film. Now you don't want to go to the bank. You can't go to the stock market to raise money. So you can apply this crowdfunding method. Since you have some followers all over the world, you can ask some company to raise money on behalf of you by small amount. It could be $10, $15, whatever. The company raises money for you and you do the project, you generate a return and you pay back to this crowd. So this has become very popular recently. People rely on these crowdfunding mechanisms to raise money for their projects. Okay. So again, it's like providing some financial service. Now we are done with our discussion. Now you may have seen I went pretty fast this discussion because other than banks, these are only these institutions are providing services in the financial system as financial institutions by way of intermediary or providing certain services. So we need to have some sort of idea about these roles of these entities because in our paper we don't have very deep discussion into these different providers or different entities, but at least you should have some brief idea about their operation. If you look at these questions, I have added some few questions at the end. You would see some of these are questions related to these different types of institutions that kind of to understand that kind of institution. Now, for example, this September 2019 paper, this first question, banks are not only financial institutions that act as intermediaries in the economy. Do you agree? Now we know banks are providing various services other than intermediation. So you should be able to answer. Now these questions are also related to some aspects of financial intermediation and service provision. I think you can look at those questions later. So with that, we are done for the day. Now I have actually given you a kind of a quiz. You have this quiz today. I gave you a 1-page or 2-page document. Look at these questions at home. Try whether see whether you can answer these questions. That is actually on money, money and monetary policy. So typically I had two quizzes during this course, since we don't have physical meetings, we cannot discuss and do it in the class, but at least we'll try to do it in this way. So please look at those questions, quiz 1, and try to answer, and let's try to find some time to answer these questions. So I think someone has provided some examples. For example, factoring company, LOLC factors, Siapatha Finance factoring. Siapatha means I remember Sampath Bank owned company. Singa Finance factoring. So I think soft logic factoring. So you have already provided some examples. I didn't want to quote any names, but most of you have provided some examples. Very good. And in terms of venture capital in Sri Lanka, I observed there was only one venture capital company operating sometimes back. They have actually provided venture capital services for power sector. So renewables, energy, power, and also for healthcare sector, they have been providing venture capital services. But in Sri Lanka, those are not very popular. I see you have done a lot of discussions as I was discussing the materials. That's really good. You have basically created your own discussion on the chat. That's really good. Since I couldn't see that chat while I was teaching, I could not interfere. But I see most of you have done a good discussion. That's really good. But when I come back to our Sri Lankan financial market next week and week after, we will get most of these things back into our discussion, and I'll be touching on some of the examples in our discussion. Okay. Shall we stop here and meet up next week, same time? And I really request you to look at the quiz 1.